Well, I could just read you all 20 pages, but I'm afraid most of you would be asleep before I got through the first paragraph. I count the number of people here, exact same number that there was last week with Barry Bond. He came and spoke, so I don't feel like I've deterred from the numbers too much. So, but anyway, what I'd like to do is kind of talk a little bit about the tax bill that was passed last December, kind of break it down into the extenders that were made permanent, and then there are some extenders that will have through 2019. Then there's other extenders that will expire at the end of 2016. Talk a little bit about some other provisions in the bill, and then kind of wrap up with the some of the tax provisions that President Obama wants to put in with his proposed budget that he released yesterday. And so the name of the bill is actually the Protecting Americans from Tax Hikes Act of 2015. Now, when does Congress protect us from tax hikes? But anyway, I'm just kind of I'm going to go pretty briefly, and if somebody has questions or something on something, just raise your hands. I'm going to skip a lot of sections that really I don't think would really pertain to very many people in this group. So if you think of something that you heard and want a more explanation, just holler and we'll change that. Some of the permanent extenders in this first section is a tax relief for families and individuals. The enhanced child care tax credit is made permanent, which is $1,000 per child. And then that once your income gets over a certain level, it gets phased out. The American Opportunities Tax Credit, which is for education, and the Hope Scholarship, that's been made permanent. And they changed they've increased it to $2,500. But later on in here, that's only a credit now. You used to be able to take it either as a credit or as a deduction, whichever is most advantageous. And they've done away with the deduction side of it, and now it's just purely a credit. But it phases out if income of $80,000 if you're single, $160,000 if you're married. They extended the earned income tax credit is made permanent. And one of the other things that was done is that it is now, I think that's in here, excuse me, that's another part. They've also extended the deduction for certain expenses for elementary and secondary school teachers. This is the $250 that they can deduct. You know, I don't know how many school teachers don't spend that much, but and if they don't, they probably take the deduction anyway, because what's it amount to? You know, 30 or 40 bucks in tax, and the IRS is never going to audit it anyway. Also, they made permanent the deduction that you can either deduct your state income taxes or your sales tax. There was a point in time, if you lived in Texas, you couldn't, since they don't have a state income tax, you got no deduction. But now they've, for those states that don't have state income tax, they can deduct their sales tax. Charitable giving. Yep.
Do they keep track of how much sales tax they pay the state?
Actually, the IRS, well, most software, if you put in your zip code, it will calculate your state, local, county tax based upon your zip code, and based upon your income, say this is what your sales tax you pay.
They just have some kind of formula.
It's just a form.
Spend about this much in sales tax.
Yeah, if your income's from here to here, this is what percentage we think you spent, and this is what you can deduct from sales tax. Or else you can keep every receipt and make that calculation if you'd like to. Incentives for charitable giving. They've modified some rules for contributions on capital gains for conservation easements. And that really applies to if you've got some land out here that's just marshland, you can't grow any crops on, you can't use it for pasture, you can pretty much contribute that as a conservation easement, still own it. It only can be used for conservation purposes, and you can take a charitable contribution for that as capital gain deduction. They've also extended a provision where you can take tax redistributions from your individual retirement accounts for charitable purposes. This applies if you're over 70 and a half. Instead of taking income from your IRA and then contributing it to charity, which means you have income, which will also impact a lot of other, if your income is higher, you may get hit with some Medicare, additional Medicare tax and everything else. This way you can take it directly from your IRA and give it right to charity and just bypass your return. But you have to be over 70 and a half to do that, and that is made permanent. There's some, they've made clarification on basis adjustments for S-stocks for charitable giving, incentives for growth and jobs and investment. You know, what's interesting is there's a lot of provisions in here that were made to stimulate the economy, but they weren't passed till mid-December. So how can that stimulate the economy 11 and a half months earlier? But they've extended, they're made permanent, the research credits. There's also an employer wage credit for employees who are on active duty members of uniformed services. There's a tax credit for that, but that's only applies to businesses that have fewer than 50 employees. Section 179 is made permanent, and it had dropped back down to $25,000 level. What they made permanent is that it is now a deduction of $500,000, but it phases out once your purchases equal $2 million. They've also, there's a certain small provision, and you don't see it very often, but there's an exclusion for 100% of the sale of small business stock. There's all sorts of hoops and hurdles to go through, but that's made permanent as well. Built-in gains, which is if you take a business and convert it to a sub S, after 1986, if you converted a C corporation to an S corporation, any gain within that corporation, if you sold any of those assets within a 10-year period, you had to recognize gain on that as if you liquidated your corporation. In other words, you had to pay income tax inside the corporation and outside the corporation, which really meant that if you were a cash basis taxpayer and you had a cash basis corporation and you had receivables, those receivables were built in capital gains, so you actually pay tax twice on that. Well, they've reduced that from 10 years down to 5 under the new bill. There's some incentives for real estate investments, investment trusts and so forth, or real estate investments as it pertains to restaurants and equipment or purchases of real estate on tribal ground, etc. And that's pretty much the sum of the permanent extensions. The extensions that are made through 2019, so we'll have it in 16, 17, 18, and 19, is there's the modification of the work opportunity credit, which is a credit if you hire somebody that's been long-term unemployed. That's extended for a few more years. Bonus depreciation, this is where you can deduct 50% of new equipment placed in service in your business. That's extended, although it starts phasing down to 40% in 2018 and 30% in 2019. Tax relief for families. As I was saying before, qualified tuition expenses, you have to take those as credit. Well, you can't take those as a deduction through 2019, so there's a few more years you can take that. Job incentives, probably the most exciting one here. If you own racehorses, those are still 3-year property, so you can deduct the racehorse over 3 years. There's also an extension of accelerated depreciation of business property on Indian reservation land, which for us out here, it doesn't make any difference, but basically anything south of I-40 and east of I-35 is tribal land, and you can take accelerated depreciation on real estate in those. It's not tribal land, but it's just anything that was part of an Indian reservation at one time, pretty much. There's the moratorium on medical device, which was part of the American or the ACA. That moratorium exists through 2019, which is a 2.3% excise tax, which has caused a lot of medical device companies to take the business overseas, so they don't have to pay that tax. They've extended through 2019 non-business credit for non-business energy property and credits for alternative fuel vehicle refueling property. So you see all these CNG stations going in. There's a reason for that, because they get some pretty nice tax credits for doing that. That pretty much. There's also extension for the qualified fuel cell for motor vehicles. So if you have an electrical vehicle, the manufacturers of those fuel cells get a tax credit. Another change that goes into effect next year, W-2s and 1099 miscellaneous forms, those are due to the recipient by January 31st, and they were due to the IRS February 28th. Well, to prevent fraud, and most of the fraud on the Internal Revenue Service, and we're talking actually billions of dollars that the IRS pays out fraudulently every year in tax refunds. A lot of that comes from people filing fraudulent returns as soon as tax season opens up about mid-January. They're claiming a refund for wages, but that W-2 didn't have to hit the IRS until end of February. So by the time the IRS could match that W-2 up to your return, you had your money, you had moved, gone off out of the United States or whatever. The IRS had paid you a nice refund, and there was no W-2 to support that refund. So to help prevent fraud, what the IRS is now doing is those W-2 forms, they are now due to the Internal Revenue Service January 31st, just the same day that they're due to the recipient. And the same with Form 1099 miscellaneous, which is your non-employee compensation and so forth. Those are due January 31st. Interest, dividends, and all the other forms are still due February 28th. They're trying to cut down on fraudulent returns. If you've been a victim of identity theft, there's some new procedures to get what's called an ITIN and ITIN, which is basically an identifier that the IRS knows that this is your return and not the person who filed your return using your Social Security number to get your refund. They are really working hard on that. It is a very, very difficult if you've been a victim of identity theft. I've known people who show up in person with their passport, and the IRS will not believe that they are the person who's entitled to the refund and not the person that got it. And so they are working hard to do this stuff. They also are preventing people from acquiring Social Security numbers and then going back for several years and claiming refunds for earned income credit, child care credit, and other credit. So there are some people who may get a Social Security number in 2016 and then go back and file amended returns for 15, 14, and 13 and try to get refunds back. Because now they have a Social Security number and can legally file a tax return. Well, the IRS says you can no longer do that. You only can claim those credits once you get your Social Security number. Another little change which applies to colleges is in the past when the colleges reported the tuition and fees that you were paid, they did that based upon what they were billed. Now the colleges and universities have to do that based upon what you actually paid. They could do either what they was billed or what was paid. Now they have to do what's paid. So that the form that they 1098-T that they send you now should match what expenditures have been. Some other miscellaneous provisions. They've made some improvements to the Section 529 funds, which is the educational money that you can put away in an educational brokerage account, which, by the way, if you use the Oklahoma plan, you get you get an Oklahoma deduction for that. They've modified what's eligible. So like computer equipment, which was not eligible, is now eligible to be used. You can use those funds without paying a penalty. Another small provision is you can roll over your pension plan and employer-sponsored 401k to a simple IRA, which is a little bit different than a regular IRA. You could roll those over to a regular IRA, but you could not roll those over to a simple IRA. And the IRS has clarified that, and now that you can. I still see eyeballs, so I'm not seeing a lot of eyelids. Guys must still be awake out there. They've also made a provision that the IRS is prevented from collecting the collection period for members in armed forces who are hospitalized or as a result of a combat zone injury. The IRS now is prohibited to taking enforcement action to collect back taxes until their injuries are healed. There's a whole section, about 4 pages, in real estate investment trust, which probably nobody would want to read. I can tell you I certainly didn't read those because I don't deal with those. Administratively, and this is where it's really kind of funny, been following the news and so forth. There is what's called a Taxpayer Bill of Rights, and it's been out there for a long, long time. Well, now they finally came up and said that the Taxpayer Bill of Rights, the IRS employee has to make sure that the taxpayer has the right to be informed. They have to offer quality service. They are required not to charge the taxpayer more than the correct amount of tax. They can challenge any challenge to the IRS position has to be heard. The appeal process has to be an independent forum. There's finality. They have to respect privacy, confidentiality. The taxpayer has a right to retain a representative. And the IRS says they must have a fair and just tax system. Who knows? Also, yeah, I know.
Say this doesn't sound like the simple shorthand.
Yeah. Also, this is very interesting. Yes, Alan? Simple and what? No, fair and just. I have no idea. They just say it has to be fair and just. Means basically what they're saying is they have to say, they can't use the tax system to unfairly punish one group of people, like conservatives or liberals or whatever. The IRS employees are prohibited from using personal email accounts for official business. Really? Surprise, surprise. The release of information regarding the status of certain investigations. It's illegal now. There's an administrative appeal relating to adverse determination of tax-exempt status of certain nonprofit organizations. An employee is terminated for taking official action for political purposes. Yeah, and there's some. That's right. There's some new rules relating to partnership audits, but that really is going to apply to large partnerships, and I won't bore you with all that. And I think that is pretty much the end of the Tax Act. Now, I kind of want to talk about what's in the new budget proposal that President Obama just released the other day. The earned income tax credit would be available to non-custodial parents. Right now, to get the earned income tax credit, you have to be the custodial parent. Even if your ex-spouse is paying all the child support, he or she gets none of the earned income credit. Now, that's available to non-custodial parents. He wants to triple the child care credit. He wants educational credits which are good for 4 years. He wants those to be available for 5 years. He wants there to be a $5,000 tax credit for employers that hire community college graduates. He wants to require employers of 10 or more people to automatically enroll their employees in IRAs if they don't have their own pension plan. He wants to reduce the tax benefits for anybody that's in the 33% tax bracket or above. He wants to increase the capital gains tax to 28%. He wants to lower the corporate tax to 28%, but include a 19% minimum tax for any income that's earned in a foreign country. He wants to increase Section 179 to $1 million. He wants the cash method to be available for any business of $25 million of gross revenue. He wants to increase the tobacco tax. He wants to increase the estate tax to 45% on any estate over $3.5 million. And last but not least, he wants to put a $10.25 per barrel oil tax, which by calculations would increase the price of gas by 25 cents a gallon. That's what's in his proposal. I doubt if most of that ever gets to see the light of day. So we got a few minutes. I would take any questions if I've not bored everybody to death. Matt.
In your opinion, if they had called you tomorrow and asked you to design a tax system that was simple and fair, what would your idea be of a tax that would fit those qualifications?
Well, simple and fair are you really can't fit those in the same sentence, because once you start making it simple, it may not be fair to the guy that has the home mortgage because you can take that deduction away. It may not be fair to somebody that wants to gives a lot of the money to charity because you're taking that deduction away. So you really can't have a simple and fair system. You can have a simple system which says everybody pays 15% tax, no deductions. You don't get a personal exemption. You don't get any itemized deductions. You just take your income, take your business expenses, pay 15%.
What do you think that would do to the national income tax?
It would probably raise it. It'd probably raise it, which is interesting. You know, the home mortgage deduction is one of those quote sacred cows. But I was reading an article this morning that more than 50% of the millennials do not even want to own a home. Home ownership is something they don't even want to do. They just as soon rent. It makes them more mobile, and millennials tend to be more mobile. So, you know, probably the fairest tax system we got was in '86 when Reagan put in basically two different tax rates. But he also, at that time, to do that, he did away with a lot of loopholes, did away with a lot of itemized deductions. But he also added a very high level of complexity to the tax code, because now instead of having income, you actually had earned income, passive income, investment income, and you had to get the income into the right buckets and each taxed a little bit differently. You could not offset, in some cases, losses of passive income with earned income.
So it wasn't simplified.
It wasn't simplified. It was
Fair.
It's fair, but it wasn't simple. So there is no such thing as a simple and fair. You can have simple, you can have fair, you can't have both.
What about maybe instead of having an income tax, you just have a sale or use tax?
Like a value-added tax like they have in Europe.
Well, I don't know what they have in Europe.
Europe has what's called a value-added tax. So every time you sell something, you collect an income tax. You collect sales tax on it. So when the raw goods is sold to a manufacturer, they collect a sales tax. When that manufacturer sells that to the wholesaler, they collect a sales tax. When the wholesaler sells that to the consumer, they collect a sales tax. And so every time that product moves from person to person, there's a sales tax, or what they call a value-added tax. It would generate a lot of revenue.
Wouldn't have to be a high percentage.
No, but there again, what do you exempt? Food? Do you exempt drugs? you know, and then if you don't exempt food, then you say, you know, you're hurting the lower economic class because they have to pay a higher percentage of their income in taxes. You know, you can argue both sides of it, of any proposition all day long. But you know, they say, well, the people who make more money are going to pay a lot more, which is true because they spend more. So there's pluses and minuses to any system. It's never as cut and dried as what one might think. Any other questions? I can make up some more answers. You can make up some more questions. So I appreciate it. I think we've got about 8 minutes left. So Doc, I'll let you do the happy pot.
Okay.